Ever wondered how a seemingly robust stock market can suddenly crash? It's a question that leaves many scratching their heads. The stock market as we know it is a volatile beast. One moment it's riding high and the next it's plummeting into the abyss. This unpredictability is part of its very nature. Let's consider the concept of a stock market crash. Picture it as a sudden, drastic drop in stock prices across a significant cross-section of the market. This plunge often triggers a rush to sell, which exacerbates the decline. The impact? It's not just limited to investors and corporations. A severe stock market crash can send shockwaves through the global economy, leading to economic recessions and even depressions. Recently, this concept of a market crash has been brought back into sharp focus. Veteran investor Jeremy Grantham, known for his knack at predicting market crashes, has sounded the alarm bells. He warns of a looming stock market superbubble burst. In his view, we're in the final stages of this superbubble, an unprecedented concoction of dangerous elements. Elements like a precarious housing market, rising inflation, complex geopolitics, and energy concerns. Grantham's not alone in his outlook. Analysts from Bank of America share his downbeat perspective, predicting a significant drop in the market by year-end. And it's not just about the U.S. stock market. Global bonds have entered their first bear market in over 3 decades, adding another layer of uncertainty. But what does this mean for you and me? It means that we're potentially on the brink of a financial shift, one that could drastically affect our economies and our lives. The unpredictability of the market, coupled with warnings from seasoned investors, paints a picture that's impossible to ignore. So what leads to such a catastrophic event? Let's delve into the chronology of a stock market crash. The anatomy of a crash is often complex and multi-layered. At the heart of it all, a market crash doesn't just happen overnight. It's a sequence of events that intertwine and build upon each other. Let's start with an overpriced market. Imagine a balloon filled to the brim with air. The pressure inside is high, just as the prices in an overpriced market are. This is often fueled by a mix of optimism, speculation, and sometimes irrational exuberance. Investors are in a buying frenzy, driving prices beyond their intrinsic value. Then comes the prick that pops the balloon panic selling. As investors begin to realize that the market is overvalued, fear sets in. This fear, often exacerbated by external factors, leads to a selling spree. It's a domino effect. As more people sell, prices drop, triggering even more people to sell. Now let's take a closer look at these external factors. Take the housing market, for instance. When housing prices drop drastically, it can lead to a decline in consumer wealth, and therefore consumer spending. This can have a ripple effect on the economy and the stock market. Inflation, too, plays a key role. When prices rise rapidly, the purchasing power of money decreases. This can lead to higher interest rates, which can make borrowing more expensive, slowing down economic growth and affecting stock prices. Geopolitics and energy are other key factors. Political instability can create uncertainty in the market, and energy prices can impact a wide range of industries. History has shown us how these factors can come together to create a perfect storm. Take the dot-com crash in 2000, for example. Overvaluation of tech stocks, coupled with the burst of the internet bubble, led to a severe market downturn. Or the financial crisis in 2008, triggered by the collapse of the housing market and risky banking practices. Understanding these steps helps us recognize the warning signs of a potential crash. Remember, knowledge is power. The more we understand the anatomy of a crash, the better equipped we are to navigate the turbulent waters of the stock market. The aftermath of a market crash can be devastating, but it also presents opportunities for learning and growth. When the stock market crashes, it's like a tidal wave, leaving no sector untouched. The economic impact is far-reaching and can lead to recession fears. The housing market, for instance, often takes a hit as affordability reaches a turning point. The energy sector might also face volatility, with geopolitical factors influencing gas flows and causing economic ripples. These are just some examples of the domino effect a market crash can have. Yet in the midst of all this, there are opportunities for investors who have the foresight to diversify their investments. Diversification is not just about spreading your investments across different sectors, but also about investing in companies that are recession-proof, companies that can weather the storm and emerge stronger. However, diversification alone is not enough. Precautions must be taken to mitigate risks. Investors need to keep a close eye on market trends, be aware of potential bubbles, and not fall victim to the euphoria of overpriced markets. It's about being vigilant yet adaptable, prepared to adjust your strategy when the market demands it. Then there's the role of central banks. In times of inflation, they have the power to raise interest rates, a move that can help stabilize the economy. This is a delicate balancing act, though. Too high, and it could stifle growth. Too low, and it could fuel a bubble. Central banks have a crucial role to play in navigating the aftermath of a market crash. In the end, it all comes down to this: preparation and knowledge. Understanding the factors that lead to a market crash, keeping an eye on market trends, diversifying your investments, and being aware of the measures central banks can take. Preparation and knowledge can be your best defense against the unpredictable market. Let's take a moment to revisit the key points we've discussed today. We started by delving into the unpredictable nature of the stock market, a world where trends can shift as quickly as sand dunes in a desert storm. We then dissected the anatomy of a market crash, a chilling phenomenon that can wipe out fortunes in the blink of an eye. From there, we ventured into the aftermath of a crash, a time of tumult and transformation that can also present unique opportunities for those who dare to seek them. We emphasized the importance of precautions, of having safety nets in place, because when it comes to the stock market, fortune indeed favors the prepared. But above all, we underscored the role of knowledge and preparation in navigating these volatile waters, because in the end, understanding the tides can be the difference between sinking or sailing. So keep learning, keep preparing. After all, knowledge is power, and in the world of stock market investing, it's your most valuable asset.